All right, let's talk PodcastOne. The company just dropped its latest earnings report. And on the surface, things look pretty good, right? We're talking record revenue and a smaller loss than expected, which sent the stock for a nice little ride. But, as always, when you dig a little deeper, you find this classic tug of war, a really promising growth story on one side and some nagging questions about actual profitability on the other. So let's get into it and break down what's really driving these numbers. So here's the game plan. We're going to start with a quick snapshot of the headline results. Then we'll unpack both the bull case and the bear case for the stock. After that, we'll see what management is forecasting, and we'll wrap it all up with our take on what to expect next quarter. Okay, let's jump right in. What were the big numbers that actually moved the stock? Well, first up, revenue. PodcastOne kicked off its fiscal year with a record quarter, pulling in just shy of $15 million. That's a really solid 14% jump from the same time last year, and, maybe more importantly, it just edged out what the analysts were predicting. You always love to see that kind of top-line momentum. Now for the bottom line. Now, you're going to see a loss here, but hold on. The real story isn't that they lost money, it's how much they lost compared to what Wall Street thought they would. They came in with a loss of 4 cents per share. The consensus forecast was a 5-cent loss, so they actually beat the estimate by a penny. And in the world of earnings, losing less money than you're supposed to, well, that's a win. So what happens when you beat on revenue and lose less than expected? The market liked it. The combination of that growth and the earnings beat sent the stock up nearly 6% on the day. Not too shabby at all. Okay, so let's put on our bull hats for a minute. If you're feeling optimistic about this company, what are you pointing to? The story here is all about growth, and more growth, plus some key operational wins. And this right here is a really big one for the bulls. It's a huge milestone, actually. For the first time in a while, PodcastOne delivered positive adjusted EBITDA, coming in at over $500,000. Now, if you're not familiar, just think of this as a measure of core operating profit, before all the interest, taxes, and other accounting stuff gets layered on. It's a massive turnaround from the adjusted loss they had this time last year. So, what's fueling all this? Well, it's their network. It's just getting bigger and bigger. They're holding steady as a top 10 publisher, which is great to see, but they're also adding new content like crazy. 14 new shows just this quarter. That pushes their active roster to over 200 podcasts. And, the more shows you have, the more ads you can sell. It's all about getting that scale. And get this. This number is just wild. A 218% surge in video views compared to last year. Whoa. Management made a really big deal about this on their call. They're basically signaling that video isn't just a side project anymore. It's becoming a critical piece of the puzzle for both growing their audience and, of course, for making money. Okay, so the growth story sounds pretty compelling, right? But, and there's always a but, it's not all clear skies. Once you start peeling back the layers on those adjusted numbers, some very real questions about sustainable long-term profitability start to pop up. And this slide, this really tells the whole story right here. On one hand, you have that positive adjusted EBITDA we just celebrated. That's the good news. But then you look at the official, by-the-book GAAP number, and the company is still looking at an operating loss of over $1 million. See that disconnect? That's the entire bear case in a nutshell. It's that gap that keeps cautious investors on the sidelines. And it's not just us noticing this. The Wall Street analysts are zeroing in on it too. On the earnings call, you had Sean McGowan from Roth Capital Partners ask what was basically the million-dollar question. He's saying, look, that's great, but when are your costs going to get in line so you can generate actual profit, not just this adjusted stuff? It's a totally fair question. And if you want to see that market skepticism in action, you just have to look at the stock chart. Sure, it popped for a day after the report, but if you zoom out a bit, it's still down a good 30, maybe 40% from its highs just a few months ago. That tells you pretty clearly that investors are waiting for more proof. They're saying, show me the real money. So with that bull versus bear backdrop, let's turn to what management is actually telling us to expect for the rest of the fiscal year. So they reiterated their full-year guidance, which is a sign of confidence. They're projecting revenue to land somewhere between $55 and $60 million and adjusted EBITDA between $3 and $5 million. If they hit those targets, yep, those would both be record numbers for the company. But here's where things got really interesting. During the Q&A, an analyst asked them, hey, how do you get to the high end of that guidance? And their answer wasn't just, oh, we'll grow a bit faster. Nope. They pointed directly at M&A, mergers and acquisitions, as the key driver. And then they dropped this huge hint, suggesting a deal could be announced within the next 90 days. Now that is a massive potential catalyst for investors to watch. Okay, time to put it all together. Let's synthesize all this into our forward-looking take on PodcastOne. This is the next call. So, we've laid out the good, the bad, and what management is promising for the future. The big question is, what does this all mean for the stock? Where does it go from here? Here's how we see it playing out. Next quarter, the narrative is going to be the same. All eyes will be on that adjusted EBITDA number. But the real wild card here, the thing that could truly shake up the stock, is that potential M&A news. If a deal gets announced, we could see the stock re-rate higher in a hurry. If not, we think the price is likely just going to chop around in a range until the company can finally prove it has a clear and sustainable path to actual GAAP profit. So, given this balanced view, you've got a solid growth story on one hand, but it's tempered by those profitability concerns on the other. We're initiating our view on PodcastOne with a market perform rating. The risk and the reward just feel pretty evenly balanced right at the current price. Now, this isn't for everyone, but if you have a higher appetite for risk, here's a potential idea. You could take a speculative position here, essentially making a bet that management delivers on that M&A hint. It's a trade built entirely around that potential deal announcement happening in the next 90 days. And as always, our final reminder, this analysis is for informational and educational purposes only. This is not financial advice. Please be sure to do your own research.